Good evening, Canada. Welcome to week 5 of the Investor's Guide to Thriving for Spring 2021. So today I got a call from my daughter's school. Another kid in her class had COVID, and now we're in isolation waiting to hear if this is a really vicious April Fool's joke. I'm hoping it is, but it's 7 p.m. in Toronto and they haven't called it off yet. I'm not the only one who got a disturbing call this week. Over the weekend, Goldman Sachs, JP Morgan, Deutsche Bank, and friends were freaking out about the so-called margin call of the century to Bill Hwang at Archegos Capital. The last time Wall Street was this stressed about margin calls on Sunday was 2008. But come Monday morning, the stock market shrugged it off, and the S&P just cracked 4,000 today. The Ever Given is being dislodged from the Suez Canal. The goods are flowing, and so is the leverage. It sure seems like Dave Portnoy was right, and stonks only go up. Well, every week that they do, we get the same question from new clients over and over again at ETF Capital Management. How can you help me sleep at night when I'm worried about all this excess in the market? Indeed, for those in retirement or approaching it, you're faced with a real dilemma. A major market meltdown threatens to derail your portfolio at a time when you can ill afford it. But at the same time, if you play it too safe, and you're on the wrong side of the inflation trade, you can lose just as much of your lifestyle to diminished purchasing power as you might to a correction. Fortunately, we have the answer for you, and Larry's going to discuss that in more detail tonight. After the presentation, if you'd like to learn more about how we apply these strategies in million-dollar-plus private client portfolios, visit us at etfcapitalmanagement.com or use the survey you receive after the event to let us know, and we'll be sure to reach out to you. Well, folks, we bring Investor's Guide to Thriving the series to Canada coast to coast, and more recently online, twice a year in support of childhood leukemia research at Sick Kids and Alzheimer's and dementia research at the Baycrest Foundation. Larry and I thank those of you who have made donations already, and if you'd like to make a donation, just use the links in that survey that you'll receive tomorrow morning, or visit investorsguidetothriving.com and use the links on the page. Of course, with all proceeds going to charity, your generosity and our event sponsors are the ones that make it all possible. So a big thank you goes out to our partners in ETF education, BMO ETFs. They've always been an unstoppable force of innovation, and the team at BMO Global Asset Management has been hard at work bringing you new and efficient ways to invest in the unstoppable force of innovation. And by that, I mean technology. To tell you more, ladies and gentlemen, it's my pleasure to introduce our friend JC, Giancarlo Rosier, Director at BMO ETFs.
Thank you, Jared. Thank you, and good evening, everyone. I just want to start with a quick question for the audience. How many of you heard of Zoom before March 2020? I mean, I have to admit that I did not. So now, I'm sure that each and every one of you have become quite familiar with the company. So COVID-19 lockdown and the pandemic has really accelerated the adoption of new technology into our everyday lives. I'm pretty sure you were familiar with Tesla. I mean, we see a picture of Mr. You all know who he is. I'm pretty sure you were familiar with him before March 2020, and you probably had an iPhone. But now more people are embracing the idea of owning an EV over the next few years, according to a recent survey. And we're excited for the advent of 5G and its promises of connected highways and connected appliances. And you probably heard also Joe Biden's infrastructure plan that he just introduced is seeking billions to beef up America's broadband, clean energy, and overall tech infrastructure. So this is another big tailwind for the tech economy, and innovative tech companies will continue to make headlines for years to come, like they have in the past year. So what I want to do over the next 10 minutes or so is to give you ways that Canadian investors can invest in technology. So investing in tech can be a really challenging endeavor for most investors. So some of the more attractive tech companies out there are trading at extremely high prices. So as you see on the screen here, over $3,000 in the case of Amazon, for example. So that makes it hard for smaller investors to really accumulate, any sizable positions in these stocks. So by putting too much into a single name or having a high concentration into a few stocks, it can really add significant single security risk to your portfolio. And that lack of diversification can really drive up the volatility of your portfolio. So ETFs have really democratized access to specific segments of the market, like the technology segment, and can solve those issues by providing exposure to a diversified basket of tech stocks. And not to mention also that ETFs have added features such as dividend reinvestment, currency hedging, and income enhancements. And ETF also can provide an efficient way for investors to tactically shift their positions based on how they feel about the market. Not that we are, we're not advocating for market timing, though I think you should leave that to the professionals. It's important to spend time in the market for the best chance in achieving investment success over the long run. So here, what we're seeing here, emerging market. So in that process of investing in technology, it is useful to look outside of North America in order to add geographic diversification to your portfolio. And a great place to find that global diversification is in emerging market equity. So conventional wisdom is that the Canadian market is highly correlated to emerging market equity, with both markets having an overweight to more resource-focused sectors. Well, that is no longer the case. So what we've seen over the last few years is that emerging market equity has really decoupled from the Canadian equity market. So it has evolved in such a way that now consumer discretionary and IT represent 41% of the MSCI emerging market index. And tech has almost doubled over the last decade and now makes up 21% of the emerging market index. So these new economy businesses include, for example, global, you probably heard of Taiwan Semiconductor. It's a global semiconductor company, and video game mega cap Tencent. You probably heard that name. They have a bigger market cap than even Facebook. So a lot of it has to do also with the rise of China as a global economic power and a dominant power in the IT space, on par with the US. So China makes up 40% of the emerging market index right now. So that's up from 12% a decade ago. And they lead the world in 5G technology, chip manufacturing, and the integration of e-commerce and social media. So, if you want to invest in emerging market ETF, there are three main ETFs here in Canada that offer exposure to emerging market equity. They are ZEM by BMO, XEM by iShares, and VEE by Vanguard. So ZEM and XEM, they both track the MSCI Emerging Market Index. That's the recognized benchmark used by most institutional investors. But however, XEM comes with a 90 basis point MER, so that's 0.9%. So that's 3 times the price of ZEM. So it's just something to keep in mind. And looking at VEE, the Vanguard offering, it tracks the FTSE benchmark, so not the MSCI, a FTSE benchmark that excludes South Korea from the index. So it's good that you do a bit of research before selecting the best ETF to access emerging market equity. Okay. So looking at the S&P 500 and the Nasdaq Composite in 2020, it was really an incredibly successful year for tech investors last year. The S&P 500 returned 18% in 2020, and that was driven mostly by gains in big tech. Companies like Apple, Amazon, and Microsoft. In fact, these three accounted for 53% of the total return last year. And looking at the tech-heavy Nasdaq, it did even better, returning a strong 44% in 2020. So the market, looking at this year, it's giving back some of these returns, especially the Nasdaq. I think that's just part of the normal cycle of investing. Again, like I said, you do have to spend time in the market, and most analysts remain very constructive on the technology sector over the long run. So S&P 500 index over time. So in business, change is inevitable, and those companies that fail to adapt and innovate, will often be doomed to failure. And what we're seeing here, the S&P acts as a snapshot that illustrates which companies and industries are the largest in the economy at any given time. So by looking at the last 10 years worth of change of the companies that make up the index, the S&P 500, you're able to observe trends and shift in the economy. So what really jumps out here from the last decade is the impact technology has had on the S&P 5 and the economy in general. So in 2010, for example, only 3 tech companies were in the top 10. And fast forward a decade later, the largest 7 companies on the S&P 500 are in the tech and tech-related space. So technology has really exploded in growth the last decade, and really has become entrenched as the largest industry powering the American economy. And the projection is that technology will continue to rise in prominence over the next decades. So how do you add, technology to your portfolio? So what we want to show you here, there are many different investment strategies that you can use to add tech exposure to your portfolio. Core allocation. So it all depends on your overall conviction level in the space and on your investment horizon. I think that's an important consideration, how much time you have before you actually need the funds, you need the money. So tech can be core allocation, making up the bulk of your portfolio that you can build around. Or, if you're a savvy investor, you can decide to add tech as a more concentrated tactical sleeve or growth sleeve to complement your core holdings, for example. But again, always remember that regardless of what strategy you are using, diversification, a disciplined approach, and cost efficiency are key things to keep in mind. So ways to access the Nasdaq. So there are a number of ETFs out there that you can use to get exposure to the Nasdaq, more specifically the Nasdaq 100, which is more tech heavy. So BMO has the most assets in Nasdaq ETFs here in Canada. So with ZQQ and ZNQ. So the difference between the two is that ZQQ is offered with currency hedging. So meaning it provides a currency neutral exposure to the underlying stock. So you don't have to worry about Canadian dollar going up versus the US dollar or going down versus the US dollar. So it really gives you a neutral exposure to the underlying stocks as far as currency is concerned. We also have XQQ here in Canada that's offered by iShares, also trading on the TSX. It's essentially the same exposure as ZQQ for the same price. And in the US, we have the granddaddy of them all. That's the Triple Q by Invesco. It's a $123 billion ETF. It is cheaper at 20 basis points for the management fee, but do remember that you have to buy it in US dollars, right? So when you factor in the conversion costs between your Canadian dollars and US dollars, it can in fact be expensive to own over the long term. Another way here to gain exposure to the US technology space is through covered call technology ETFs. So these strategies allow you to capture the growth of the tech sector while at the same time benefiting from very tax efficient, very sustainable income. So the income is achieved by writing call options on the underlying stocks in the portfolio. So looking at the space here in Canada, there are 3 ETFs in the space. First one, TXF by First Asset, that's been around since 2011, and it's the largest of the 3. Here at BMO, ZWT was recently launched back in January. So it provides an exposure to 30 of the largest North American tech and tech-related companies. That's including Shopify here in Canada. So the income is derived by writing out-of-the-money call options on 50% of the portfolio. So those are great options for investors who really want to access the growth potential of the tech sector and at the same time, satisfy their need for sustainable cash flow. So really exciting here, new development in the ETF space the last couple of years, and a new way to look at the market for tech and for growth investors is through mega trends and disruptive innovation investing. So mega trends, those are future drivers of market growth. So these are trends that are very large in scale, that will impact our behaviors, our needs, and that will also impact companies, businesses, and industries across the entire globe. You've heard some of those mega trends. There are fintech innovation, genomic, autonomous driving, clean energy. So thematic investing with ETFs or investing in these megatrends, that's been made popular by ARK Investment in the US through their series of 5 actively managed ETF that offer exposure to these various trends that I just mentioned. So here in Canada, BMO, Horizons, and Emerge are the main players in the space. Emerge, they offer a direct replication of ARK's ETFs in Canadian dollar. So you can buy them on the TSX in Canadian dollar, but essentially replicating those same 5 mandates in the US. And BMO here, so through MSCI, we've entered into a partnership with Cathie Wood, the founder of ARK Investment, and we're offering a suite of 5 innovation ETFs that track essentially the same investment universe as ARK Investment. So moving on to the next slide, passive versus active and single stocks to access innovations. So there are a number of ways for investors to get exposure to disruptive innovation themes. So you can obviously buy individual stocks, but that can be a risky proposition because you're betting on a single company in a growing, dynamic, and very fluid sector. Or you can use ETFs for added diversification. I mean, you have choices of actively managed ETF in the space. So I mentioned, ARK Investment, that's what they offer. So ARKK, that's ARK Innovation. That's the biggest ETF in the space. That's managed by Cathie Wood. It captured lots of headlines, continues to capture lots of headlines, and a lot of cash flows last year. It's sitting at 17 billion right now, and returned well in excess of 150% in 2020. I mean, we can all agree that that kind of performance is not sustainable year after year. So it's given back some of this performance this year, but it's still a great investment for people with a 5-year and longer time horizon, investment horizon. And as far as BMO, we offer a passive rules-based version of ARKK. So that's the ticker you see on the screen here, ZINN, the BMO MSCI Innovation Index. So ZIN essentially gives you exposure to the same stock universe as ARKK. The difference is that Cathie is actively picking through the universe and is offering more concentrated positions in names like Tesla, for example. So it's a much more narrow, much more focused and concentrated portfolio. And as far as ZINN, we're providing exposure to the whole universe of disruptive innovation companies. So that approach is a top-down approach. We think it's a pure play because it maximizes access to that mega trend, at the same time providing better diversification, lower turnover, and lower cost to investors. So this is what I had to share with you today. To wrap it up, we invite you to join us at our next Market Insights webinar. That's on Friday, April 9th at 1 p.m., where we will actually be discussing mega trends investing. In fact, Cathie will be our featured guest, so you don't want to miss that. And with that, I appreciate your time. Thank you. Have a nice evening. Enjoy the long weekend. And I'll pass it over to Mr. Larry Berman.
Thanks very much, JC. Normally, folks, I would have my video on, but my internet signal at home is running on the low side. And just in case, I thought I would go without video tonight. I'm very excited about what Cathie Wood does. And if you recall last year, I was recommending a lot of the ARK ETFs in terms of our best picks. One of the restrictions I have in the funds that I manage for BMO is that I can't own actively managed ETFs. So if there's an ETF that isn't linked to an index, I can't use it in the funds that I run for BMO, ZZD, for example. So I went out, I asked BMO, I alerted them to this great trend, and as the great partners that BMO are, they delivered with a ZINN, which is an index-based model off of Cathie Wood's best ideas. So I love that. The problem is right now I don't love it because of market risk and valuation, and that's really the subject of what I want to get into tonight. So I'm going to give you a little bit of an update on Pro Eyes. I'm going to talk about volatility and complacency, and then I'm going to take a deep dive on some technology issue, ETFs, some valuation, and then market timing around the decisions and how I do some things in technology. And then Q&A, as we always get to. So, okay. Again, if you haven't had a chance yet, please, please, please follow along weekly with our Pro Eyes Probability Return on Investment Index. The idea here is very similar to the Fear and Greed Index that CNN runs, but it's much, much more in depth. Not only does it encompass the 7 factors that CNN has, but we have 20-factor model, 12 tactical indicators, 4 measures of valuation, 4 measures of the business cycle, of which CNN only has 1 of those 8 metrics in it. So I think it's far more robust. It's going to give us guidelines for when we need to take less risk and when we can be comfortable taking more risk in our portfolios. And this is the modeling that generally drives my talks on Monday, on Berman's call, when I say I'm a bit concerned, there's certain factors, and these are some of the things I'm looking at. So I wanted to talk about volatility specifically this week. Those of you who follow along with the markets closely, and I imagine that's most of you out there, pay attention to the VIX index. So one of the ways the CNN Fear and Greed Index, it looks at the VIX, so the current VIX index relative to its own 50-day average. And I did some historical testing on this, and I thought, yeah, this is actually pretty good. It works really well over time. And so how do we test that? So we use a statistical technique to measure the deviation from the mean. And this blue line at the bottom is measured in standard deviations, how far VIX is deviating from its own 50-day average. So historically, when you get a spike in VIX that is 2 standard deviations above its own 50-day average, that's a pretty good indication that you're close to a low. You're not at a low. You don't know what day it's going to be. You just know you're getting close. Now, the indicator here and the data we have go back about 20 odd years on this indicator. The next VIX one I'm going to show you that's linked to VIX futures doesn't have as much history. So, as indicators develop, as things we're able to back test and we see their strong efficacy over time, we will add and subtract from our index here we're always going to try to improve our signal and what it's trying to tell us. So right now, we are very, very close to, as VIX is now below 20. I may have closed below 18 today. Historically, the standard deviation, long term, about the S&P 500 is about 18. In recent years, given the market's generally been trending higher for the last decade, the standard deviation has been close to 15. So a VIX is basically measuring standard deviation of the market, basically. A slightly elevated down into the low teens is very, very low. So at 18, still relatively elevated, but compared to its own 50-day average, now remember, 50-day average was at a very, very high level a year ago, and it's been coming down and down and down and down. So you'll see in the commentary part of our analysis, we look at what VIX itself is doing relative to the previous week, and then what it's doing relative to the 50-day average, and then what the 50-day average is relative to itself. So there's 3 aspects to what we're trying to measure here. And there's at this point, there's no reason to panic here. There's nothing on the volatility side that says this is a no-brainer, you got to step up and get out of the market. But we are getting closer to levels of complacency. There's no doubt about that, but it's one factor of many that we look at. To look at any one factor by itself is just too much. It's too concentrated, and you always want diversification no matter what you're doing as a general guideline. The second thing we look at is volatility compared to future volatility. So we're using the futures markets here. And what we're looking at is the first month VIX futures. So what is the expectation for volatility 1 month from now compared to the expectation for volatility 4 months from now? So how much risk is the market pricing in now relative to what it thinks it's going to be a quarter from now? Okay, and the relationship of current volatility to future volatility is very important. And as we can see again on the blue line at the bottom, generally speaking, when this deviates by 2 standard deviations or pretty close to, this lines up very, very, very well with important turning points. And volatility is a much, much better indicator to help us identify market lows than it is market highs by a long shot. However, it's helpful at market highs as one factor. And we can see now, based on the last 7-8 years worth of indicator here, that we're now starting to get to a level where the expectation of volatility is significantly low for the next month relative to what it thinks it's going to be in the future. And so this is an interesting dynamic here. And I've said for maybe about a month or month and a half now that, with the expectation for all this stimulus and expectations and what companies are telling us about earnings and pre-announcements and everything else, we're actually okay through that mid-May. So earnings start so next week we're going to focus on earnings on the presentation here. But earnings are going to start to be upgraded significantly, I think, based on everything that companies are starting to recognize and tell us and reopening. And there's just a lot of hope developing. We got very, very good news from Pfizer today that on the 6-month, review of their phase 3 testing, that the efficacy of their vaccine is still very, very strong 6 months later. That is very, very good news that we're not seeing the efficacy fade away. So it's still, I think COVID's still going to be an issue for a couple of years still. It's not going to go away. Just because we're getting vaccines doesn't mean you're not going to get outbreaks in schools, as Jared talked about, and so forth. I heard today 84 schools in Ontario have COVID shutdowns now. So we're not there yet, but we're getting there. So a bit of complacency is coming into the volatility measures. But when you weigh that against some of the other factors, again, valuation, there's nothing about the markets I like at all. There's no reason the market multiple should be expanding here. However, sometimes the market narrative and the hope drives the psychological part of the market, just dominates. And we're in one of those periods right now where there's just not a lot of things to be pessimistic about. And there's far more things to be optimistic about. So it's going to price in more here. Now, at some point, probably early May, mid-May, June, I don't know when, but at some point, I think we want to batten down the hatches again, because all this good news needs to be paid for at some point. And when the bill comes due for that, they're going to have to issue a lot more debt. And if the Fed doesn't step up with yield curve control and significantly more QE, then that supply of debt is going to push yields higher. and that's going to be a problem for the stock market, and specifically large cap technology that gets a lot of leverage from falling and negative real yields. And so that dynamic is in front of us, and we have to be aware of that. We don't have to worry about that today. So when it comes to great company like Amazon, so I took Amazon here back to its inception, 1997, on the 14th of May, 37.68% annualized returns. Who doesn't want that in their portfolio, right? Like, right? Really? So when it comes to what a stock does and earnings and valuation, this company actually doesn't make any money in their core business of selling stuff to people. And that's the vast majority of that. And it really only until they bought Whole Foods that they're actually making money selling stuff. It's been a loss leader since the company started, basically. They're making money on cloud hand over fist. They're making money on other services, but they're still losing money on selling stuff to people. It's an incredible dynamic and a story. So when it comes to what drives valuations in technology, the narrative, the hype, sometimes is so much more overweighted than anything else. But you never know when that is going to end. And that's the hard part about getting into things that are just more speculative compared to mature companies with well-defined earnings where you can run your dividend discount model and you kind of know what something's worth. So technology is a sector, especially the innovative, especially the disruptive, that I don't think anybody on the planet really knows how to value properly. And I get called a dinosaur by a lot of people on Twitter because they say you don't get it, you don't understand. I do understand bubbles. I do understand manias. And I think it's really important. Most of the younger folks investing today don't know what a bubble is. They don't know that Nortel was 35% of the TSX at the peak and no longer exists. They don't know that. They may have heard of it, but it's not part of what they think about. So here's Amazon and its revenues and earnings per share. And you can see 2017 to 2018. Okay, you saw a big jump up in earnings per share. Well, guess what that was, right? That was a bit of Amazon Web Services, and that was a lot of Whole Foods. And when you look at the online sales and the third-party seller services, and when you dig into the financial statements, out of their revenue that in 2021 is expected to be $473 billion, that 3/4 of that doesn't make any money for them, or very little. This is an incredible story. So it's really hard to value because of that, and because I have a value tilt to me, I tend to miss out on some of these things. So another way of looking at it then is what Peter Lynch made famous in one of the very first books I read in my career, One Up on Wall Street, from his 1989 book, actually. And he talks about this thing called the PEG ratio, and that is the price earnings relative to its growth. But again, here within the case of Amazon, forever there were no earnings or negative earnings. And that up until very recently was Tesla. But even now, Tesla doesn't earn anything other than their green credits that they're selling. They still don't make any money selling cars. Now, they may one day, but again, it just makes it fundamentally very difficult to put a value on. And Kathy Wood is one of the best in this area. that bear steepener definition, Investopedia, forget that's there. That was something from last week's presentation. Don't know how it stayed in the presentation. It should have been taken out. So my bad for that. So here's Amazon in the first five years. So this is a stock that went up 7,400% from the bottom in 97, just after it came public. It sold off aggressively to the peak in 99, and then the peak in early 2000. This stock, from its first peak in 99, had a 63% correction. Actually, before that, it was a 57% correction. Retested the high in late 1999. And by the time 9/11 hit, in the aftermath of September 9/11, where the stock bottomed, it was down 95%. So this is a stock that has a lifelong 37% compounded return. But folks, there's no one on the planet that can hold a stock through that type of volatility. I imagine some of you have stocks in your portfolio that are called val-nil, meaning they're not worth anything anymore. They were a speculative mining company one day. We all have them. I put my hand up on that for two. One almost cost me my marriage 25 years ago, or probably a bit more than, probably more than that, closer to 30 years ago now. Anyways, I won't get into that today. So again, valuing these companies when they're more speculative and the earnings are not stable and clear is extremely, extremely difficult. When it comes to the tech sector overall and large cap tech, I'm not talking about micro caps and brand new companies that are teeny tiny that trade for pennies sometimes. I'm talking about large cap mature companies. There's 75 of them in the S&P 500. So on an equal weight basis, which is the ETF RYT, each stock, when they do the rebalance a couple times a year, gets set to 1.33%. In the sector spiders, which everybody likes to use to play the sectors, XLK is the technology sector spider. Prior to a couple of years ago, that technology sector spider actually included telecom too. And they split it out a few years ago and when they created the communications group. So there's some legacy in that ETF that isn't entirely clear technology. It included some telcos once upon a time. So just be mindful of that. The history, though, of XLK has averaged, compared to when RYT started. So RYT started in 2006. XLK goes back into the early 90s. 1.25% annually more. So, but the vast majority of that outperformance has come in the last 2 years. That orange line deviating from the white line has really come in the last 2 years. And it's at a time when Apple and Microsoft basically doubled in size and their PEs relative to their histories expanded 40, 50%. So today in the market cap weighted version, XLK, Apple's 21.5%, Microsoft just under 20%. The two of them more than 40% of the ETF, and you can see the rest. But it's IBM and up. I guess you can, right? IBM's 1.33 and up. So the top 16 names are overweight compared to the equal weight version. So if you think technology on average is going to do better, you want to own the RYT. If you think large cap tech, and in particular these names are going to do better, then XLK is a better play. So when you're calling me, Larry, up and saying, what tech ETF should I buy? That's the kind of analysis I'm kind of doing And though as the wheels are spinning, as you call into BNN, and I say, I like this one over that one. Have a look very quickly at the analysis I did here of the top few names. So Apple has a PE, a forward PE of 28 times earnings. The trailing PE, so TPE, is 33.3, and the historic 5-year average is 20.4. So you've got a stock that's trading way above its 5-year average and colossally above its 20-year average. And that's all happened in the last couple of years. Microsoft, same narrative there. It's trading at significantly higher than its longer term averages. When you look at the next tier, so Visa, Nvidia, MasterCard, PayPal, Intel, Adobe, look at these names. This is interesting because Visa is trading at 37 times forward. The 5-year average is around 34. So higher, but only a little bit higher. Nvidia, 5-year average of 48 is trading below. MasterCard, okay, that one's got a little premium. PayPal is trading below its 5-year average. Intel is right in line, and Adobe is below. So technology has only done well, and in terms of outperformance, because of Apple and Microsoft expanding the multiple. And what is the driving factor in expanding the multiple of these two stocks? And that is the incredibly low interest rate. And recently, part of the stay at home, right? Especially in the case of Microsoft. I mean, our company, Microsoft Teams, and what it does, we swear by it. So, when I look at Amazon and I compare it to KWeb, so the top chart there is KWeb, and that's the one I featured, which is the Chinese internet stocks, and I list the top holdings there in the graphic. How do we know that KWeb is not where Amazon was in 1999? How do you know that? How do you know that this isn't a big bubble about to break if interest rates normalize? If interest rates have been the catalyst for pushing this thing to the roof, and now the rates are backing up, we're seeing weakness here in technology all around the world. But in particular, the antitrust and the political backlash we're seeing not only in the US, but in China and in the EU and in a lot of places. So to me, this is a big risk. Now, I'm not saying it's going to fall 96%. Don't get me wrong. I love tech. Tech needs to be part of everyone's long-term growth portfolios. And folks, Canada has very little of it in the TSX. We have to look globally for tech, as JC pointed out in his presentation. So very important when you think about that way. So how do we know that it's not this? But how do we know a great ETF like ARK that we see here in the top graphic, okay? And in the top graphic, I cut it off at the high in February prior to COVID. How do we know that it isn't going to do what it did? And that is have a dip, a significant dip, and then rip higher. So how do we know this dip is not just another dip? The answer, folks, is we don't know. When we're in a mania and a bubble, and it's about the narrative, and it's about Cathie Wood coming out with a $3,000 price target by 2025 for Tesla and adding more to her portfolio, and the media picks it up and everyone loves a good story. How do we know when it's all going to end? And the answer is we don't. There's nobody on the planet that knows this. So how much of it do you have in your portfolio? It's always about risk and return. Is this going to be a great ETF 10 years from now, in terms of the companies, but how much of that is priced in today? And I'll tell you, nobody can tell you that. So I came out and said on my show this week, I think KWeb could fall another 15 to 30%. I don't know. I think it can for lots of reasons that I can easily articulate, not in a 30-second clip. It would take a little bit longer. But antitrust, just what governments are going to need to do. Joe Biden's raising taxes on cars. He's going to make sure Amazon doesn't hide all their money in tax regimes that don't pay the U.S. government anything. Like, this is, the governments are broke. They're coming after big tech to pay their fair share. So we'll see how it all plays out, guys. But there are a lot of challenges to the valuations in these areas, notwithstanding the great, innovative, disruptive stuff that they're doing. So put that on the scale of justice and figure out what that means for your portfolio. I'm avoiding it for now, but I love it long term. So that's just a little bit on some of my expanded thoughts on the area. So again, here's an idea. I love these ETFs that allow us to hedge and not hedge. And so when risk factors are high, but we still want to participate, NGen, so the innovator ETFs out of the States have this buffer strategy, not only for the S&P that I talked about last week, but for the Nasdaq as well. And you can buy the NGen, Nasdaq January edition. You can buy the N April that launched today, and you're going to get 15% downside protection over the next year, and you're going to get probably 12, 13% upside. So if that fits for you, maybe you just play tech that way for now. But here's what you have to do with these, and this is what we do for our clients in our portfolios that Jared talked about before. When I think the risks are high, I put a buffer on the portfolio. And when I think the risks are low, I take the buffer off. So that's one of the ways. So you can see here, if you held NGen a year ago, relative to just holding the Qs, obviously when the markets are going up, you're going to do better in the Qs. But when the Qs fall from being up 20% in February to being down 20% in March, the NGen was up only 5 and fell to only minus 10. But as Qs ripped higher, you didn't get all the upside. You got your 10 because that's what it was designed to do. Okay, it was designed to give you 10 because that's the cap. To pay for that insurance, you sold away some of the upside with a covered call. That's how these ETF works. I think they're great strategies. They're called call or put spreads. We do them for our clients. We can now do these in our BMO funds. I begged BMO last year. We finally got permission to do that, and I'm very excited to be able to begin transitioning our BMO portfolios into using these that give us upside but allow us to protect on the downside. So again, all our educational content, including replays of this webinar tonight on our YouTube channel. We're coming up on 7,000 followers on our YouTube channel, so something you might want to check out if you're looking into all our educational efforts. So for the Q&A period here, let's get into it. It appears that many are expecting an increase in spending in the U.S. as a result of COVID relief payments. Can you give us an indication as to which sectors of the economy will see the greatest benefit and which ETFs might benefit from the increase in spending? So here's the thing. For the top 25% of people, they don't need the money. They're not getting much in this current bill. I think it was capped at incomes of 75,000 and families of 150. So if you're in the top 25% of income earners in the US, your family is probably making more than 150,000 a year. So you didn't get any. So most of this is going to go into the bottom half. And the bottom half that are generally paycheck to paycheck are going to spend almost everything but they're going to spend it on maybe back rent, paying down credit cards, and essentials. It's not spent on luxury items. Are people going to take a vacation? Yeah, sure. There's a lot of that, but that's because they have savings and they couldn't, not because of the relief payments. So I don't think there's an area that you could say, yeah, there's definitely going to be a big spend and go buy this ETF. So it's a great question, something to think about, but I don't think there's a no-brainer answer here in terms of what you would want to own there. Someone's asking about TXF. So this was an ETF that we saw featured at the top part of the presentation tonight, and apparently they're changing the style of what they're doing here. Maybe they're broadening it out. There hadn't been a big pickup in the use of that fund. Again, it's one that I could never own because it was kind of an actively managed strategy. It wasn't linked to an index. But I like covered call technology generally if you need a yield from what you get, because the Nasdaq pays less than 1%, and technology in generally is very low yielding. What BMO did with their ZWT was to take the highest yielding tech stocks and write covered calls in them. So it's a little bit of a different flavor, but still a way to generate a yield, and they do it the way BMO does it. So is it common practice for the ETF industry to change the investment objective? It's not common, but the reality is, come a point in time, if there's not enough assets in a strategy, a company will close it or merge it. This has been done in the mutual fund industry forever. Funds not doing well, they say, we're going to take those assets and we're going to roll them into Fund X. You have the option to sell or stay. And they end up retaining probably 70 or 80% of the assets because most people don't care or don't know to care. And the ones that want to leave will leave, as opposed to closing it down and giving everyone their money back. So you're going to see that as a matter of practice, the way the industry does things. So I hope that answers your question. I just did a quick check, and it appears that the S&P is outperforming many available ETFs. If I'm correct on that, do you think the growth will continue? My brother mentioned that there's a good chance of a crash. What signs do we look for to prepare for, just in case he's living in Hawaii? First of all, if it's going to be that bad, Hawaii is a great place to be. Go visit your brother and take me with you. But this is where, watch our Pro Eyes indicators. When I comment, on there that time to reduce risk in the portfolios, that's the time you get out of your S&P 500 and you buy one with a hedge in it. So that if the market doesn't correct, or it only corrects a little bit and then keeps going higher because we're in a bubble, then you're going to get some upside still. Now, cash is trash because it yields nothing these days. So depends on who you are, depends, do you need an income, depends, are you comfortable getting out of the markets and all out and all in? It depends, again, do you need a yield to live off of? Because cash doesn't pay you a yield. So there's no one right answer for anybody, and it's all really about you. So when we sit down with a client in our You Potential business, and we're doing a financial plan for them, the last thing, the furthest thing from importance, is what goes in the portfolio. That almost doesn't matter. It's about reaching your goals. Now, if your goal is the biggest portfolio possible, that's a different thing. But if your goal is to make sure you have enough cash flow to live in retirement, to make sure your living standards don't change as you age, then it's not going to ever be about timing the market for you. It's going to be about participating in a smart way. And that's a really important learning thing. So I don't know who you are asking the question. if you're 25 or you're 65, because the answer is going to be different. I imagine you're a bit younger, given the tone of the question. So maybe sitting in cash, but if you have FOMO, if you have fear of missing out and sitting in cash bothers you, then look at those innovator ETFs as a way to play it and stay involved, but be a little bit more defensive when you're doing it. What would be the reason for an individual to purchase a Canadian bank ETF and pay a management fee when you can buy the individual banks themselves and pay little or no fees through an online provider? Great question. And the answer is you're absolutely right. If you have the time and the inclination to buy them equal weight, rebalance them on your own, do it on your own. Why pay an ETF provider to do that? Well, here's the answer. Because let's say you only have a few $1,000s. Well, then you can't buy a board lot of each stock. If you bought a board lot, 100 shares of each bank, but you had to do it so they were equal weight, that's probably, I think you're pushing on probably $50,000 portfolio. Now, most people have that. But if you only have $50,000, then it's all in the banks. If banks should only be maybe 10% of your overall portfolio, then you need a $500,000 account to do that. But you don't if it's just one ETF. So again, depends on who you are and what your goals are, because really that's the critical thing here. What are your goals? What are your needs? And that is going to help define how you go about doing business. And as I said, what goes in the portfolio, that's like the last thing. Most people who are on the do-it-yourself trend, they think that that's everything, and it's actually not. So I don't know if that answers your question or not, but those are some of my thoughts there. First Trust Canada offers 4 buffer ETFs. Yes, they do. And so they're done quarterly. The innovator ones in the US are done monthly. So I like that better. And they reset. So how do you decide? So here's how you decide. You have to have a market view. So sell in May and go away. So which one would you buy in May? Do you buy the May one? Because if the buffer support doesn't kick in till the market falls 10%. So let's say between February and May, the market's up 10%. And when the February one was set, the protection was, say, on the S&P 500 from 3,700 to 15%, call it 3,200. I'm just using round math there. So let's say that was your buffer. So now the S&P is at, and let's say we're going to launch the May one now. So let's say it's April, not May. And now we're at 4,000 on the S&P. So that February one, the buffer doesn't kick in until you're down at 3,700. So you got more downside risk. So Innovators and First Trust has a dashboard on their website, and it shows you how much protection and when it kicks in and where the caps are and how much upside you have left and so forth. That is critical knowledge. For our portfolios for clients, what I do is I take an active approach. So every quarter I reset 25% of the portfolio to always be currently hedged, meaning I'm going to look at it now and say, okay, so the March contracts just expired. And I looked to March 2022 and said, what's the most likely upside downside scenario given my best expectation a year from now? I think we're going to hit a fiscal cliff in 2022, and there's going to be a recognition that there's no more government dole. The Congress is going to go back to the Republicans. There's going to be no spending for the next 3 years. I think that's going to happen. And so we're going to see a growth problem. Now, at some point, the Fed steps up and they have to spend more, but that's not going to be until the markets come unglued again. So I put more protection on the downside. I put one of these ultra buffers in where I'm protecting 25, 30% of the downside, which means my cap is a little bit lighter, but I got more downside protection. And so that's how you have to think about using these things. Okay, so hopefully that gives you some good insight. Do you see the increase in bond yields after significant headwind to emerging market ETFs? So yes, but it's not about bond yields as it is about the US dollar. So as yields go up, if the US dollar is getting stronger vis-a-vis emerging market currencies, then there's stress in emerging markets because they rely on trade and so forth. And so a strong dollar makes life more expensive and risky for emerging markets. A weak dollar, very, very positive for emerging markets. And so as the dollar has gotten stronger in the last month and a bit, as yields have gone up, we've seen EM correct 10% on a relative basis compared to the S&P, for example. Now I'm using that as a buying opportunity because I believe that the US policy is going to want a weaker currency, and the Fed is going to continue to tell everybody that they're anchored at zero and don't worry, we're not going to raise rates, even though the market thinks we are going to start to raise rates. And then ultimately, if yields push up too much, they're just going to have to do yield curve control. And whether it works or not is another matter. It's worked for decades in Japan. It hasn't created any growth for Japan, don't get me wrong, but it's worked in terms of stabilizing the interest rate markets and creating that environment of negative real yields. Can I get your opinion on ZMT, which is a big part of my infrastructure play? I'm a 2/3 invested. Was wondering what you would believe to be a good level and to add to my final tranche. So let's have a look. Now I recently both traded out of it and reduced, and then I added back in. So let me bring this chart up here. I talked all last year about this being the best way to play infrastructure because people are going to need metals and copper and aluminum as we build bridges and steel and so forth. So I still love it. Now, against this high, and it rolled over, I trimmed here. I think it was probably on this day right here. And just the other day, actually on this day, I bought back in what I trimmed up here. So I'm very active in the strategies. Is this a bullish chart pattern developing here? I'm not sure. But then when I look at it on a multi-year basis, so let's go back as far back as we can. Now, when we look at when this thing peaked coming off the great financial crisis, it's $120. We're at half of that. So the question is there enough infrastructure spending? Is the greenification of the world, the demand for copper, is the ability to fix bridges and steel and rebuild, less globalization, more building at home, more infrastructure, is that going to drive steel, aluminum, copper, zinc, nickel to where we were a decade ago? And I would say that we're going to get closer to it. So yes, there's some natural resistance here from the highs a few years ago, but you got to be a dip buyer here. Where do you do it? I don't know where you're long. It's hard to be that precise. But yeah, I just bought back in what I trimmed. So there you go. Do I think ZSP is a good investment of $10,000 for a senior, or should I buy Sun Life? What do I think? Again, great question. I don't know how much money you have. This is where, I got to know something about you. I got to know your income. I got to know your needs. So do I put you in one company that has, company specific risk, or do I say and has double the yield of 500 of the biggest companies in the world and expose you to the US dollar? Like, that's the question you're asking me with $10,000. How meaningful is $10,000 if it gets cut in half from here, right? Is that going to change your style of life? Those are the more important questions than should I do this? And my answer then generically is going to be, I'm always going to recommend you do something more diversified than less. So I would advocate for the S&P 500 over one single stock. You're going to have far more volatility in the single name than you are in the broad market. You're talking about an insurance company versus the world, 40% of the world index. So, I need to know more about you to get more precise than that kind of answer. Bitcoin ETFs, what may cause Bitcoin to pull back 20 to 30% or more? So great question. It may be a buying opportunity. I possibly would like to have 1 or 2% portfolio weighting in Bitcoin. So I'm never going to buy it. It's speculative. I don't know how to value it, but it could be worth $1 million one day, right? So that's, a lot of people are asking this question right now. Should I just buy it just in case? Tell you what, if you're going to do that, put it in your TFSA. So if you have $50,000 in your TFSA and you have $1 million in all your other accounts together, and you're going to put 1 or 2% in, put $25,000 of your TFSA in Bitcoin, representing, 2% or whatever. Because if it goes to $1 million, you're not going to pay tax on that. And isn't that a wonderful thing? So in your totally for speculation account, that's where this money should go. I have no idea what the volatility is going to be like. What would cause it to do that? Probably something around legislation, probably something around a big player dumping, probably something around, and apparently 90% of it is owned by, a couple dozen people. Manipulation, because they want to shake people out and buy it lower. Any number of reasons. I have no idea what could do it at any point in time. There's going to be legislative action against it. Make no mistake about it. They're going to tax it. Transactions will be taxed, capital gains, probably at an income level. Like, it's all coming. When it happens, how they do it, I don't know. But there's so many risks to it. But if enough people are thinking like you that they want to put 1 or 2% in just in case, it's going higher. What the stable value of that is, I think it's worth next to nothing. But again, that's my dinosaur hat on. Question I have, it seems like long-term treasuries and gold are highly correlated for the past few years. Why invest in both at the same time or one over the other? And a bonus question, if bonds have negative real yield, who's buying them? When big money, pension funds, insurance company has, Manulife. With all the insurance policies, I'm making up numbers, these aren't real, I'm just giving you an example. Manulife at some point down the road is going to owe $1 trillion. I don't know the number, because they've written life policies and death is certain. So they've got this liability into the future of $1 trillion, right? And so if they have these assets that today might be hundreds of billions that they're investing to pay for that future liability, it's got to earn a yield. It doesn't have to be real, because in the case of that insurance company, that future liability also gets deflated by inflation, right? So it becomes the nominal yield, not the real yield for liability matching. And the same is true in lots of different ways when you think about that future debt and future liability. So one of the reasons governments want real negative yields is so their future debt in current dollars gets cheaper. But that only works if you can grow your way out of it. So you're not adding to the level of debt at a faster rate than your GDP, right? And the math around that dynamic is absolutely brutal for the next 30 or 40. The demographics, I've talked about it for years, are absolutely brutal. And the cost of debt is going to be a real big problem for governments. It's staggering how they say, well, debt's so cheap. When Trudeau comes out and says, well, the cost of debt is so cheap, why don't we just keep borrowing? And so this is the MMT world we're ultimately heading into, where they're just going to print money. I don't see any way out of it, and therefore you want gold and bonds, but gold will still shine in the future, notwithstanding periods of volatility, like we're going through now. So they are very different asset classes. Bonds have a yield, gold has no yield. So if you need a yield, then you tilt towards bonds. You have significantly more volatility in TLT than you do in gold, so that's another factor. Great question. That gives you some answers. And so people who have written in tonight. So question, I've always been curious. Can you tell us about your average day watching over your various funds? How much of your day you spend trading, or you set up your trades prior? Always been curious. That's a great question. So thanks for asking that. So I run 7 different funds right now. I run 3 for BMO and we run 4 internally. One of the internal funds we run is in the area of real assets and infrastructure, and that is real estate and infrastructure, pipelines, new green technology, and we're a manager of managers in that strategy with a bit of public exposure for liquidity needs. I spend a lot of time on that fund. We did a conference call just a few days ago with a firm named Marshall Zayres. Marshall Zayres does lending into the areas that banks want no part of, typically financing construction. You can earn 10, 15% yields financing the building of a condo, of a strip mall, of a residential construction, of commercial. Banks don't like that risk. They don't like that there's no cash flow coming, etc. So they shy away from that, and there's this whole niche market that's really blowing up in private. So that's one of the things I do. We run a strategy that's very similar to ZPay. I love, and for years I've loved what you can do writing puts. I've talked about options for years, writing puts and calls. BMO does it exceptionally well. I've got a mandate for our clients. It's a little bit more dynamic than what BMO can do in a public mutual fund. For example, I can write up to 130% puts, knowing that almost in every situation, I'm not going to get put on every single thing I do. And if I do, I'm buying on average 10 or 15% lower, buy low, I love it. And I can get called away and sell high. So I'm able to create a strategy that generates a yield closer to 8% in option premium that still has half the volatility of the markets. And it's got a few more tools in it. I can be dynamic in hedging. So that's another thing that I do. How do we set up for that? So I built analytics. If I knew this question was coming in, I might have been able to show this to you, but we've spent a lot of money building tools to say, okay, I got $1 million to put to work today. Where's the best place to put it? So 2 ways I can own a stock. I can be long with a covered call, and my minimum objective is to own a stock today where the target price a year from now is at least 20% higher. So I look at consensus target. I look at a bunch of technical targets we can create different ways. And if that's at least 20% higher, then I'll be long the stock and I'll write a call to earn that extra 6%, 8% yield, okay? In any given month, I want to make a minimum of 5% of that 20 before it gets called away. And there's different ways you can write. I can write at the money call, right? Like I buy something at 20 or 50, I write a 50 call, I get a big premium for the month, probably 1.5% right at the money. So I'm making my yield, but I'm only writing it on half the position. So if it goes up that month more than 5%, I make a lot more on the other half. So again, I'm able to do things that are a lot more dynamic in that strategy. In our ETF rotation strategies, you know, again, I can use a little bit of leverage. So what we do is different in the different mandates we do. In the yield fund for BMO, I've got to get a 4% plus yield. So I've got to be in covered call ETFs. Nothing, very, very little yields 4%. So I can build a very concentrated portfolio of high yielding stocks, but that gives me a lot of sector risk and I want to diversify and so forth. So again, lots of different things to do, but the question every single day, and whether it's me looking at it now, today I'm not traveling and you know, I don't do a lot of that these days, the last year, but our trading desk sits there all day and they've got all the tools in front of them and they know that if this happens, buy that, if that happens, sell that, and it gets executed for me. And it's not like me sitting there trading all day. I don't do that. Although these days I'm in front of the screen a lot, that's for sure. So thank you for that question. What are the impacts of a Canadian investor as a result of the carbon tax ruling last week? I've never fully understood the carbon tax, and I would appreciate your thoughts. So the basic rule in economics is that you apply a tax to something you want less of. And so historically, they're called sin taxes. So you put a big tax on cigarettes if you want people to smoke less. You put a big tax on booze if you want people to drink less, and so forth. And so you put a big tax on carbon if you want people to use less carbon. So here's the problem with that. People who live in the suburbs and people who have some wealth, they want their luxury. They don't want to take public transit, right? So you're going to drive your car. You got to go get your groceries. You need your car. You need a vehicle. Now that vehicle can be green, that's fine. But putting a tax on carbon to get someone who has money to stop using their car, the cost of a gallon of gas needs to be astronomically expensive, right? So a tax like that to me becomes a bit of a nuisance. Now, if you're doing it and your neighbor to the south is not doing that, then your businesses get a competitive disadvantage. In other words, their input costs go up relative to their competitors. And so, you know, there's a lot of different ways to look at it, but the basic economic model is to tax things you want less of. So I'm an advocate of doing that, but there's probably better ways to do it. And what Trudeau did was absolutely ridiculous by saying, I'm gonna charge these carbon taxes, but I'm gonna give you money back. Like, so what's the, you know, that really doesn't, you know, cut it. Like, if you want to do that, what you charge a very specific tax on something, like a toll on a road, so that when there's a pothole in that road, you take the toll to fix the pothole. That seems logical to me. So in the sense of a carbon tax, we have to heat our homes, right? So if you're going to do that and you want that and you want to pay for it, so you create the carbon tax, but that money needs to make your homes more efficient. So it needs to go towards putting a solar panel on your roof or a wind turbine or something, so that you can come off the grid and you can stop using carbon like that, or carbon capture or something like that. But governments are absolutely stupid when it comes to spending our tax dollars, and so people push back on it. Now, you know, when Andrew Scheer ran against Trudeau in the last election, and he has a slogan of "Axe the Tax," and you don't have a viable plan to address climate change because it's real, and you better believe it's real, that you lose, right? It's not good enough. So I'm not an advocate of carbon tax. I think you can tax some things, not everything. To me, it doesn't make sense to tax home heating. You're not going to use less of it, but maybe through smart technologies and better thermostats, and you know, so make those things cheaper for people. You know, the things you want more of, you use nudge, you subsidize. You want people to opt into something, you default them to opt in, and charge them to opt out of it if they don't want it. Like that. That's how nudge works. So carbon tax is a kind of nudge, you know, and I would say it makes sense in some areas. I think it makes sense for car usage. If 100% of that money goes towards building a better infrastructure so that, you know, Elon Musk doesn't have to do it himself, so to speak. And there's charging stations, and you know, you can go and swap out your battery in 3 minutes at the same, you know, time it would take you to put the thing in your tank and fill up, as opposed to sitting there at a pump, you know, for 20 minutes waiting to get a charge and that kind of thing. So, but technology, the great thing about technology, it's going to solve a lot of the distance problems we have. And so again, you got to be wildly bullish on technology here. And so to have taxes so that we can invest in technology, and when we talk about Green New Deals, like the way governments portray those, they just don't play out well. They just don't talk to the people in a smart, intelligent way to get them to buy in. It just becomes so polarizing and political. So, you know, it's a great question, and those are some of my thoughts there. GM is up almost 100% in the past 6 months. Do you view GM as a tech player in the EV market? And how do you choose an entry point after such a large move? So that's a great question. Let me see if I can bring up a chart of GM here and have a look. I don't think I've looked at the name in a while. Now, keep in mind, you know, a lot of the ETFs that come into play in the EV space are owning a lot of the car companies. I think inevitably, 5 years, 10 years, 20 years, in that window, all cars at a minimum are going to be hybrids, or they're going to be hybrids powered by some other source of fuel, some greener source of fuel, as a backup. As like there's going to be, technology is going to solve those distance issues and whatever. And I get when people say, yeah, Larry, but where I live, it's cold and your battery does. I get that. Yes, today that's true. Tomorrow it won't, or 5 years from now it won't. They'll figure it out. I'm wildly bullish on the engineers and innovation. So again, I love what Cathie Wood is doing, but the story and the narrative is not the stock, is not the market risk side. And so if the volatility doesn't bother you, then you plug your nose and you own it. If the volatility is something that keeps you up at night, then it's not as easy. And then you ask questions exactly like this. It's had a huge move up. How do I get in? And so if you believe in the story and the vol doesn't bother you, you plug your nose and you buy it. If the volatility bothers you, you look at the charts and you say, is this a good breakout? If it is, and this is a new range for GM, then it shouldn't ever go back below its old highs. And so if you buy it and it starts going back below 40, something's wrong and you should probably get out. And you got to define your risk and return. So The next part of that is say, okay, if I'm going to buy some at 57.80 and it goes to 50 and then 45, you still like it. It's still above 40. So how much do I buy now? And the question is, if you believe, you buy a third of the position now. And if it tests 50 and hold, you buy another third. And if it breaks out to new high, maybe you add another third. And then it gets overbought again and you cut a third. And then it pulls back again, you buy it back. And then it goes up again, you sell a third. And it goes up more and you sell another third. And it goes up even more and you're out. And then it pulls back again and you buy your third back. That's how I trade, right? We don't know what's going to happen. We don't know where support is necessarily going to be for sure. We don't know where resistance is going to be necessarily for sure. And we scale in and we scale out. And you gotta, that's how I do things. So when we're picking stocks or ETFs, we scale in and we scale out. Great question. Next one, it's appearing more and more each day. I'm personally scared when I read about it. What are your thoughts on residential real estate? It seems out of control. Well, so you need your house. So you need your primary residence. I would not own 2, 3, 4, 5 homes right now, unless if something really bad happens, I lose my renters, I can carry those, I lose my job, I can carry those mortgages where I'm not forced to liquidate a property. And then I can wait to get a new renter. And so again, it's a personal thing. Like the narrative is not your situation. I don't care if my personal property goes down 30%. I don't. I need a house to live in. I'm glad it's going up, but I don't care if it goes down, right? Now, I would if I was thinking about downsizing and selling tomorrow, but that's not the case. So all these things are very personal. But I think you got to be nuts to lever up on real estate today. But you could have made that statement at any point in the last decade, right? And it's been going up and up and up. So what breaks real estate? The ability not to carry it, right? So if interest rates start going up, what happens? All the people who are on the bubble can't afford. They start to sell. Market softens, economy softens. Fed cuts rates, they go down again. There's so much debt and leverage in the system. When they tell you interest rates can normalize, I don't believe it. Interest rates are going to be at zero forever. So let's look at what makes interest rates rise, inflation. If inflation starts to tick up, meaningful inflation, and when I say meaningful, I'm saying not supply squeeze because we don't have enough microchips, because that'll be solved in due course. I'm not saying that OPEC can't ramp up production significantly and all of a sudden oil's back at $50. They don't want that today, right? That's supply side. I'm talking about demand pull. Demand pull because we can't get enough of it and we want it now and we don't care what it costs. So you have to have the means and the ability to spend. And that means incomes need to rise. And I'm not talking about incomes of one-time check or 2 times or 3 times, universal basic, giving people money. If we get into that world, inflation's coming back in a big way, folks. Depreciating currencies, gold is your friend. Bitcoin is probably your friend too. Real assets that will hold their value relative to depreciating currencies. So real estate's relatively attractive. But if the banks have to raise interest rates to kill inflation, the global economy collapses, 1930s. Okay, so when can rates go up? Right? That I keep coming back to that. It's a circular argument for me, folks. It's the biggest question I think the world faces from a retiree standpoint who wants a safe retirement income with no volatility, but it's not available anymore. because of where interest rates are. So the future is going to be a challenge. And these are some of the things. That's a great question. I think about it a lot. Last question here. It's 8:30. I'm a younger investor. You referenced Nortel. Can you please explain the problem with Nortel and why it was a bubble? So Nortel was one of the first kind of companies to connect the internet to, like Cisco, to build routers. As the internet was being born, Nortel was part of BCE. It spun off into a separate company. And then it turns out they didn't patent their products very well. They ran into competition, and it traded at a valuation that they could never ever grow into. And then they messed up, like BlackBerry messed up, right? BlackBerry had the lead. They were the first ones in smartphones. Where are they today? They're not players anymore because they didn't go to apps, right? What people wanted. They didn't. They have them now, but it was an afterthought. Their first tablet was catastrophically bad. And that's what happened to Nortel too. Their products didn't keep up. They didn't innovate, and disruption. So, great. Anyways, folks, happy Passover for those. Happy Easter. Whatever you celebrate this year, best of the season. Hope this next lockdown for everybody is an easy one, and eventually we all get our jabs and life normalizes for everyone. Be safe and have a great week, everyone.